97 years of stock market history have been compressed into a single, terrifying signal that just flashed for only the fifth time since 1928. If you've been riding the wave of the S500 over the last 3 years, you aren't just witnessing a bull market. You are standing inside a triple streak anomaly that has historically served as the ultimate trap for retail investors. Between 2023 and the end of 2025, the market delivered back-to-back-to-back returns of over 16%. On paper, your portfolio looks invincible. But beneath the surface, the Shiller CAPE ratio, the most reliable barometer for market overheating, has just surged to levels that have only been seen twice before. Right before the dot-com implosion and weeks before the 1929 crash. We are no longer speculating about a potential correction. We are tracking a mathematical inevitability. The 2026 midterm election cycle is now colliding with a market concentration so top-heavy that just 7 tech stocks are currently holding up the entire global economy like a pillar made of glass. When those previous 4 triple streaks broke, the aftermath wasn't a healthy dip. It was a brutal, systematic extraction of wealth that took the average investor over a decade to recover from. Right now, the smart money is quietly exiting the room. Institutional desks are rotating into cash and defensive value at a rate we haven't seen in 20 years. They know something the headlines aren't telling you. There is a specific 18% drawdown trigger hidden in the historical data of the 2026 midterm cycle, and the countdown has already begun. If you don't know exactly what happened in those 4 previous instances, and more importantly, if you don't have the 4-step rebalancing strategy to pivot before the ENA triple streak snaps, your life savings are effectively a ticking time bomb. We are going to dissect the raw data, the historical precedents, and the exact move you need to make with your capital in the next 90 days to ensure you are the one buying the bottom, rather than funding someone else's exit. Most people will wait for the news to tell them to sell. By then, it will be too late. Here's the data they are ignoring. To understand why this triple streak is so lethal, we have to look past the green percentages on your brokerage app and into the cold, hard mechanics of the market gravity. In the history of the S500, a 3-year run of 16% or higher isn't just good luck. It is a statistical outlier that pushes the pendulum so far in one direction that the snapback isn't a question of if, but a matter of physics. We've seen this script play out 4 times before. In the late 1920s, the roaring 20s felt like a permanent plateau of prosperity. In the mid-50s, the post-war industrial boom created a sense of American invincibility. In the late 90s, the Internet was supposed to have killed the business cycle forever. And most recently, in the lead-up to the Great Financial Crisis, the housing-led surge felt like a wealth machine that would never stop. Every single time, the narrative was the same. This time is different. But the Shiller CAPE ratio, the cyclically adjusted price-to-earnings ratio, doesn't care about narratives. Right now, this indicator is screaming. For the uninitiated, the Shiller CAPE doesn't just look at today's earnings. It looks at a 10-year average to smooth out the noise. When this ratio crosses the 30-point threshold, the historical probability of a massive correction within the following 24 months climbs to nearly 90%. As we sit here in 2026, we aren't just over 30. We are pushing toward levels that mirror the peak of the dot-com bubble, a period where the Nasdaq lost 78% of its value and took 15 years just to break even. The pain point for the average investor isn't just the potential for a red day. It's the time value trap. If you are 45, 55, or 65 years old, you do not have a decade to wait for the S500 to recover, back to its 2025 highs. When the triple streak breaks, history shows the ensuing sideways or down market lasts an average of 1,200 days. That is 4 years of zero growth while inflation eats your purchasing power alive. This brings us to the glass pillar of 2026 market concentration. We are currently living through the most top-heavy market in the history of modern capitalism. In 1929, the market was diversified across railroads, steel, and manufacturing. In 2026, the entire S500 is essentially a leveraged bet on 7 tech companies. If Apple has a supply chain hiccup, if NVIDIA faces a regulatory hurdle in AI, or if Microsoft's cloud growth slows by even 2%, the pillar shatters. Because these 7 stocks make up such a massive weight of the index, their individual volatility becomes the market's systemic risk. You might think you're diversified because you own an index fund, but you are actually more concentrated today than a day trader in 1999. Then, there is the 2026 midterm election cycle. Historically, the second year of a presidential term is the most volatile year for the stock market. Why? Because the honeymoon phase of policy is over, and the market begins to price in the uncertainty of a divided government. When you overlay this 18% historical drawdown trigger found in midterm years onto a market that is already exhausted from a triple streak, you get a perfect storm. The smart money, the institutional whales and hedge fund managers, don't wait for the storm to hit. They watch the smart money flow index, which is currently showing a massive divergence. While retail investors are still pouring money into the S500 at record highs, the big players are quietly moving toward the exits, liquidating positions into the very liquidity that retail investors are providing. You are effectively buying the shares they are desperate to sell. The mystery we have to solve today is not whether a correction is coming. The math has already decided that. The real mystery is why the Federal Reserve and the mainstream financial media are still projecting a soft landing when every leading economic indicator, from the inverted yield curve to the tightening of credit conditions, is flashing code red. They are telling you to stay the course because they need your capital to keep the prices propped up while they rotate into defensive value. Think about the psychological toll. You've spent the last 3 years watching your net worth climb. You feel smart, you feel safe. You've started budgeting for that early retirement or that second home. But the 18% drawdown trigger isn't just a number. It's the point where fear turns into panic selling. Once the S500 crosses that 18% threshold, the automated high-frequency trading algorithms kick in, and the sell orders cascade. This is how a 10% correction turns into a 30% wipeout in a matter of weeks. But here is where the story takes a turn you aren't expecting. Most doom and gloom analysts will tell you that the solution is to sell everything, bury your cash in the backyard, and wait for the world to end. They want you to live in fear. But if you look closer at the data from those 4 previous triple streak breaks, you'll find a startling anomaly that the perma-bears completely ignore. The danger isn't that the market is going to crash to zero. The danger, the real hidden trap that is about to catch 99% of investors off guard, is that the crash might actually be the best thing that could happen to your portfolio, provided you realize one shocking truth. The S500 is no longer the market. While everyone is staring at the Big Seven and waiting for the crash, there is a ghost market of assets that has outperformed the S500 in every single midterm cycle for the last 50 years, yet it currently represents less than 3% of the average retail portfolio. If you are looking at the 2026 crash as an endpoint, you've already lost. The real game isn't avoiding the red, it's realizing that the very signal that is about to destroy the S500 is simultaneously triggering the greatest wealth transfer event in the history of the commodity and value sectors. In fact, the data suggests that the smart money isn't actually moving to cash to hide. They are moving to cash to reload into a specific sector that is currently priced at a 70% discount compared to the tech giants. Everything you've been told about diversification through index funds is about to be proven wrong. To survive 2026, you don't need a shield, you need a pivot. And to understand that pivot, we have to look at the one chart that no one on Wall Street wants to show you on the nightly news. This is the chart Wall Street is hiding. The commodities to S500 ratio. It tracks the price of stuff, energy, metals, food, relative to the price of paper assets. Right now, this ratio is at a 50-year low. It is literally at the same level it was in 1971, right before commodities entered a decade-long bull run while the stock market went nowhere. The ghost market isn't a mystery. It's the physical world reasserting its dominance over the digital one. Oh, but here's the micro hook. You can't just buy a gold bar and hope for the best. In fact, if you buy the wrong hard asset right now, you're just walking into a different kind of trap. The smart money isn't just buying gold. They are positioning for a specific liquidity gap that occurs when the big 7 tech stocks begin to deleverage. Let's look at the 18% trigger in the 2026 midterm cycle. Historically, midterm years are a roller coaster. The market hates uncertainty, and 2026 is the pinnacle of it. But when you overlay the triple streak of 2023 to 2025, the math changes. Every time we've had 3 years of 16% plus gains leading into a midterm election, the drawdown hasn't been a slow melt. It's been a vertical drop. Why? Because the retail floor is made of glass. Think about who is holding the S500 right now. It's not just institutional giants. It's millions of individual investors who have been trained by the last 3 years to believe that every dip is a buying opportunity. This is called recency bias. When the market drops 5%, you buy more. When it drops 10%, you hold. But when it hits that 18% threshold, the historical midterm floor, that's when the margin calls start. That's when the forced selling begins. The algorithms, the HFTs, are programmed to front-run this panic. They see your stop-loss orders. They know exactly where the pain point is for the average 401 KD holder. When the S500 crosses that 18% line, the liquidity disappears. The exit sign is a door 3 inches wide, and there are 10,000 people trying to run through it at once. You've been told that diversification is your shield. It's not. If you own an S500 index fund, you aren't diversified. You are 30% concentrated in just 7 companies. If those 7 companies experience a multiple compression, where investors decide they aren't willing to pay 40 times earnings for a tech company, the index doesn't just dip, it craters. This leads us to step 1 of the 4-step rebalancing strategy, the 10/20/70 cash rule. Most people tell you to stay fully invested. That is the most dangerous advice you can follow in 2026. The smart money is currently moving to a 20% dry powder position, not because they are afraid, but because they are predatory. They want the market to crash. They are waiting for you to be forced to sell your Nvidia or Apple shares at a 40% discount so they can buy them with the cash they're stockpiling right now. But here is the cage. Where do you put that cash so it doesn't get incinerated by the inflation that always follows a market stimulus? This is where the asymmetric hedge comes in. There is a specific ticker, a volatility pivot, that has a mathematical correlation of minus 0.8 to the S500. When the triple streak snaps, this asset doesn't just go up, it explodes. In 2000, it was certain energy plays. In 2008, it was a very specific type of treasury bond. In 2026, it is something entirely different. It's a sector that has been starved of capital for a decade, and it's currently trading at a 70% discount to its historical mean. If you aren't looking at this sector, you are essentially flying a plane with one wing. You are betting that the 2020s will look like the 2010s. But the triple streak signal tells us that the 2010s are dead. We are now in a mean reversion era. The Federal Reserve is in a corner. If they cut rates to save the market, inflation spikes and the ghost market of commodities goes to the moon. If they keep rates high to fight inflation, the glass pillar of tech debt shatters and the S500 hits that 18% trigger. They are not coming to save you. They are trying to save the system, and the system often requires a wealth reset to clear out the excess. Think about the psychological toll of the time value trap. If you are 50 years old and you lose 30% of your portfolio in 2026, and it takes the market until 2034 to get back to even, you didn't just lose money, you lost your 50s. You lost the ability to retire when you were healthy enough to enjoy it. That is the extraction we talked about. It is the systematic transfer of time from the retail investor to the institutional desk. But there is a fail-safe built into the data. In every one of the previous 4 triple streak breaks, there was a 14-day window, a grace period, between the signal flashing and the actual cascade. We are in that window right now. This is why the Smart Money Flow Index is diverging. The price is still high, but the conviction is gone. The big players are distributing their shares to the public. They are selling you their winning lottery tickets right before the drawing. To survive this, you need to understand step 2, the beta reweighting. Most investors focus on alpha, the gains. In 2026, you must focus on beta, the volatility. If your portfolio has a beta of 1.2, you are essentially 20% more volatile than the market. In a crash, that 18% trigger becomes a 22% wipeout for you. We are tracking a specific death cross in the market concentration charts that hasn't been seen since the Nifty 50 era of the 1970s. When that cross completes, which the math suggests will happen within the next 90 days, the soft landing narrative will evaporate overnight. You'll see the headlines change. They'll go from inflation is under control to systemic risks rising in a single weekend. By the time you read those headlines, the 18% drawdown will already be 10% deep. The HFTs will have already locked the doors. But remember what I said. This crash could be the best thing that ever happened to you. Because while the S500 is the trap, there is a secondary engine of the global economy that is about to ignite. This is the sector that the smart money is rotating into. It's not a tech company. It's not a growth stock. It's a foundational utility of the 21st century that is currently being ignored because it doesn't have a flashy AI story. Yet, without this specific sector, AI doesn't work, the magnificent Seven can't scale, and the global economy grinds to a halt. The data shows that in the 24 months following a triple streak break, this specific value pivot has outperformed the S500 by an average of 400%. Most people will miss this. They will be too busy holding the line on their tech stocks, watching their net worth bleed out 1% at a time, hoping for a bounce that isn't coming. They are waiting for a return to 2025, but 2025 is gone. The real question isn't, when will the market crash? The real question is, when the market pivots, will you be holding the bag of the old world or the keys to the new one? The smart money has already made their choice. They are looking at the 1,200-day sideways cycle, and they've realized that the only way to win is to stop playing the S500's game. They are moving into the ghost market because that is where the liquidity is going. If you want to know the exact 4-step rebalancing strategy, including Step 3, the volatility buffer, and Step 4, the commodity spring, you have to look at the historical precedent of the 1929 recovery. Not the crash itself, but what happened after the crash to the people who moved into defensive value early. They didn't just survive, they became the new elite. We are about to look at the one red flag indicator that has a 100% success rate in predicting the exact day the 18% drawdown begins. It's not the Shiller CAPE, and it's not the midterm cycle. It's a credit stress signal that just turned red for the first time in 20 years. If you see this signal and you don't move, you aren't an investor anymore. You're a gambler who doesn't realize the house just changed the deck. Here is the credit stress data Wall Street is terrified you'll find. The credit stress signal that is currently screaming red is the widening divergence in high-yield option-adjusted spreads, OAS, relative to equity volatility. In plain English, the bond market, which is almost always smarter than the stock market, has stopped believing the soft landing fairy tale. While the S500 has been chasing all-time highs, the cost for corporations to borrow has begun to decouple from the risk-free rate. This is the exact technical signature that preceded the 2008 liquidity crunch and the 2000 tech collapse. It's the sound of the plumbing in the global financial system starting to crack. When the cost of debt rises for the very companies that are supposed to be driving growth, the glass pillar doesn't just lean, it shatters. This leads us directly into the completion of our 4-step rebalancing strategy. We've covered the 20% cash rule and the beta reweighting. Now we must implement Step 3, the volatility buffer. Most investors think hedging means buying put options or shorting the market. That is a fast way to lose money through time decay. The volatility buffer, utilized by institutional desks, involves moving a portion of your portfolio into non-correlated alpha assets. In 2026, this isn't just gold. It's the carbon and insurance-linked securities, ILS markets. These assets do not care if the S500 drops 20% or if the Federal Reserve raises rates. They are tied to physical and environmental realities, not market sentiment. By allocating just 5% to 10% of your capital here, you create a shock absorber that actually gains value as the panic selling in the S500 accelerates. You aren't just protecting your principal, you are generating liquidity at the exact moment everyone else is losing it. Finally, we reach Step 4, the commodity spring. This is the core of the ghost market we discussed. The secondary engine of the global economy that Wall Street is ignoring is the physical infrastructure and energy sector, specifically uranium and copper. Here's the reality no one is talking about. You cannot have an AI revolution without a massive increase in power generation. You cannot have an electric future without the minerals to build the grid. While the Magnificent Seven tech stocks are trading at 40 or 50 times earnings, the companies that provide the literal atoms that power those bits are trading at 10-year lows relative to their cash flow. This is the commodity spring, coiled and ready to snap. In the 1970s, during the last Great Triple Streak failure, the S500 stayed flat for a decade, while hard assets and energy producers went on a 400% run. We are seeing the exact same setup in 2026. The smart money is using the 14-day grace period, this current window of high prices, to exit their overvalued tech positions and buy into the producers of the physical world. They are swapping digital promises for physical necessities. The 18% drawdown trigger in the 2026 midterm cycle is not a disaster. It is a filter. It is designed to filter out the retail investors who are blinded by recency bias and reward those who understand market physics. When that death cross in market concentration completes, the transition will be violent. The time value trap will snap shut on millions of people who thought they could wait it out. But for you, the 1,200-day sideways market isn't a period of stagnation. It is the most profitable window of your life. You now see the full picture. You understand that the triple streak is a mathematical exhaustion point. You know that the Shiller CAPE is screaming that the party is over, and the credit stress signal is showing you the exits. You have the 4-step blueprint. Hold 20% dry powder, reweight your beta to avoid the tech crash splash zone, build a volatility buffer with non-correlated assets, and position yourself at the base of the commodity spring. The mystery of why the Fed and the media are still projecting a soft landing is solved. They need the exit liquidity that your capital provides. But you are no longer a source of liquidity for someone else's exit. By understanding the ghost market and the physical pivot, you have moved from the group that is being extracted to the group that is doing the positioning. The next 90 days will likely be remembered as the most critical period for wealth preservation and creation in the 21st century. The data is clear, the historical precedents are undeniable, and the signal has flashed for only the 5th time in a century. This isn't about fear. It's about the cold, calculated realization that the world is shifting from a digital multiple expansion to a physical value reversion. While the rest of the world waits for the evening news to tell them what happened, you are looking at the chart that matters. The one that shows the secondary engine of the global economy just starting to fire up. The triple streak is about to break, the glass pillar is about to crack, and the 18% trigger is waiting in the wings. But you aren't standing in the path of the wave anymore. You've already moved to higher ground. You've realized that the greatest wealth reset in history isn't a threat. It's an invitation. You have the data, you have the strategy, you have the keys to the new world. Now, all that remains is the math. The math is indifferent to your opinion, but it is incredibly rewarding to your preparation. As we enter this 14-day grace period, the difference between those who lose a decade of progress and those who capture the commodity spring comes down to one thing: information asymmetry. While the mainstream headlines will continue feeding you the soft landing narrative to ensure you remain as exit liquidity for institutional desks, we are tracking the movement of the Smart Money Flow Index and the credit stress signals in real time. The transition from a digital multiple expansion to a physical value reversion isn't a single event. It is a systematic migration of global capital. To navigate the 1,200-day sideways market that history dictates is coming. You cannot rely on the same data sets that led you into the tech concentration trap. You need to see the charts that Wall Street keeps behind the paywall. The granular data on uranium supply deficits, the copper liquidity gap, and the specific technical signatures of the 18% drawdown trigger. We have built this platform to serve as your dashboard for this transition. We do not trade on sentiment, we trade on the cold, hard mechanics of market gravity. If you intend to be part of the group that is doing the positioning rather than being the source of the extraction, you need to be here when the next signal flashes. We are entering the most volatile 90-day window of the 21st century. The glass pillar is already showing microfractures, and by the time the news reports the break, the 14-day window will be long gone. By joining this community, you are securing your access to the raw data before it becomes a headline. We are monitoring the volatility buffer and the commodity spring developments weekly to ensure that while the S500 hits its mathematical floor, your capital is already deployed in the ghost market. The door to the old world is closing. If you want the technical updates and the specific timing of the 18% trigger, ensure you are connected to this feed. The math has already decided the outcome. Your only job is to stay ahead of the curve. Let's look at the next phase of the pivot.